In this video, traders, we're going to look at the triangular moving average. What's it all about? How can it be used? Stay tuned. Hey guys, warm welcome to you. All right, so you've probably heard of the simple moving average. You've probably heard of the exponential moving average. Simple moving average, very simply put, is the average of price over the period that you're looking at. So a 10 period simple moving average is the average of the prices over that 10 periods. For daily chart, most of the time the moving averages are based off the closing price. You can adjust them off the high or the low or the open and sometimes the midpoint, but you're kind of splitting hairs there. So based on the close price for all those days, average of that, and that's just basically then plotted, and we see those curves that we famously see on charts of different colors. So that's the SMA. EMA is slightly more weighted to price that's near to the current day. So it adds a little bit more weighting to that effectively. Right, so what is the triangular moving average and how can we use it? Triangular moving average is basically double smooth. So it's an average of an average. So we're smoothing things out even more. We'll get to in a minute why we might want to use that. So for example, if we're using a 5-period SMA, 5-day SMA, we've got the price on day 1, price on day 2, the closing price on day 1, 2, 3, 4, 5, adding them all up, dividing by 5, giving us the average price over that 5-day. That's the one plot we make. And then as we add the next day, you know, we'd add day 6, we'd drop off day 1, and then we'd plot that, you get the idea. Now, a triangular moving average, slightly different in that we're taking the simple moving average of day 1, the simple moving average of day 2, the simple moving average of day 3, day 4, day 5, and dividing that by 5. So we're smoothing out what's already been smoothed. You know, if you can imagine, hopefully you can see this on the screen, if you could imagine, and we'll take a couple of colors here, the smooth, you know, the SMA is kind of doing this, pushing up, then we're basically taking a moving average of this rather than, let's say, price, which might well be kind of doing this, if you like. It might be kind of a bit up, a bit down, and that's what the moving average generally does. Instead of taking a moving average of that, we're taking the moving average from that, so it's been even smoother. So that's how we calculate that. Most charting packages do have it. However, little hack guys, if you don't have it, you can, and some charting packages allow you to do this as well, you can have a simple moving average of a simple moving average. So very often the charting platform will say, well, what do you want to use as the base for the moving average? Because often you can put it on volume, often you can put it on price, well, price obviously the main one, you can put it on other things. So if you can use the reference point as another moving average, then you've got your triangular moving average, because it's taking those data points and averaging those out, giving you that triangular moving average. All right, so when might we want to use it? What's the advantages or disadvantages of this? So this could be a plus or a minus, really depending on how you want to look at it. Slower to respond. So if you wanted to, let's say, get into longer term trends, you might find a traditional moving average is a little bit too choppy, a little bit too quick to respond. If you're using a moving average crossover, it might alert you a little bit earlier than you want. You might want it to be even smoother and less volatile. Now, the obvious answer that you may be shouting out at the screen or your iPad right now is saying, hey, well, why don't I just extend the time? And that's perfectly correct. If you want to smooth out your moving average, you just extend the time that's looking at the moving average. But just another way of doing it. So slower to respond. The negative side of that, of course, is that if it's taking so long to respond, it's going to be a seriously lagging indicator, guys. You are going to be way behind the curve if you have a strategy that requires you to get on when things are happening quickly. You're going to be late to the party, and like I say, it'll be something that you're looking for longer moves, because you're going to be possibly chasing things a little bit by the time you get the signal, depending on what strategy you're using, of course. Less noise is the advantage, just like I alluded to before. You know, if we're smoothed, obviously smooth just means average, means that we're not going to see, if there's a price spike that's causing the SMA to spike, then this will be a little bit later to it. So if that price spike comes back, then you're not going to see that noisy spike that you would see on the SMA, because obviously it's going to be smoothed out over the average prices. And exactly what I said there, smoothed out spikes. So if you do get significant spikes, the SMA is tracking, because it would go over a shorter period, then that triangular moving average wouldn't necessarily track them. So if you want to smooth out these spikes, perhaps you're in a market that's very spiky, has these kind of extreme moves from time to time, a little bit less liquid, then maybe the key to kind of dampening that down and making those trading decisions is to use the sort of smoothing effect of the triangular moving average. Anyway guys, that's the triangular moving average. Some advantages to it, some disadvantages. Would I suggest that you go out there and start scrapping all your moving averages and stick a triangular moving average in there? No, I wouldn't. But it's something to be aware of. It's there, it's available. If you come across a trading strategy, you think, if it was a little bit smoother, if it was this, it was that, then maybe you can kind of dig that out of the indicator library or plot your own and see if that's effective for you. All right, guys, take care. See you next one. Bye-bye.